Hello and good evening, everybody. Hi,
Hi
Nelson.
Benny. Hi Benny. Hi everyone. Hi everyone. It's good to
How you
be
doing,
back.
Nelson? Had
How
your
am I
dinner already?
doing? How am I? I dinner not really, not really. It's
Not yet, so late.
on diet probably.
So you're gonna have your dinner at 12 tonight, right?
No lah. After this go sleep already on diet lah.
All right, guys. Thank
How
you
are
very
you?
much
How are
for
you?
joining us. Yeah, if you can hear us, can you just type yes on the comment section? Hi, Arul.
Hi Trip Plus.
Yeah, Trade Plus is in as well. Yes, today we have Nelson. Nelson is from Afin Huang Asset Management.
Yeah. Hi.
Okay, awesome. What about the rest of the other guys? Are you all ready? If you can hear us, can you say yes?
I think we should expect more people, right? Since it's like MCO, you got nowhere to go and stuck at home.
Yeah. Hopefully, the middle of the week. Okay, we normally get people a little bit later lah.
Yeah.
Like 8:05, 8,
Yeah.
8:10.
It's Malaysian timing anyway.
Yeah. Yeah, we have an interesting topic anyways today. We're gonna talk about how you can expand your investments outside of Malaysia. Hi,
Yeah.
Dejavu. Okay. So what I'm gonna do is basically I'm gonna share with you guys why we should look out of Malaysia for investment. But the good thing is how you can do it in Malaysia. Okay, that's the most important part. So and that's where we get Nelson here, who's going to share with us how you can do it, how you can actually invest. And the focus today is actually on the China market and also the real estate market in Asia itself. All right. So
How you
let me
can
just
expand
put
to
up my
this with
screen.
using a ringgit maybe.
Yeah, you don't
That's
need
the
to
best
bring your
part,
money
right?
outside.
Yeah.
It's basically just investing in Bursa Malaysia itself, right?
Mm.
Okay, let me just get this up. So once again, thank you everybody for joining us tonight. Well, I guess we're probably going to be the MCO will be probably until end of June. Looking at the numbers, it's still not going down yet, right? So hopefully that we are continue to stay with us, so that we'll bring you, topics that may be able to benefit you in your investment journey. All right. So tonight's topic is basically expand your investment horizon into Asia, which part of Asia and how you can do it. And that's what I want to basically share with you guys. All right. So before that, whatever that is being shared here today is for educational purposes only, right? It does not constitute any investment advice whatsoever. And if you want to look for investment advice, please make your own due diligence or look for a professional licensed investment advisor. All right. So I'm going to cover basically two parts today. One is China. We call it new China, right? Because these are companies that has been around relatively new. I mean, China has a long history, and of course, before this there were a lot of public companies, right? And now we have a lot more private companies, and of course, we hear companies like Alibaba and Baidu and WeChat and Tencent and so on and so forth, right? So we're going to talk about that in a short while, and then I'm going to also cover the real estate market in Asia. All right. But bear in mind, this is just a basically, it's just a surface for you to do more research. All right. I'm just going to point out why, based on the information and the news that we have currently, and of course, based on the data itself. But if you really want to go deeper, just do an extra digging yourself or your own due diligence so that you're able to understand better. All right. So this is basically more on the surface on why I think that we should be looking to invest outside Malaysia, but in Malaysia. All right. So let's take a look at China. So the focus is basically in China, right? If you look at China's GDP, I mean, if you look for over the past 20 years, the growth has been tremendous, right? Except there are some years when the GDP growth stays stagnant, like what we see in the past 3 years, right? But you will see that whenever the market start to grow, it will grow aggressively again, right? So if you look at, for example, China versus the United States. And of course, US is the largest economy in the world, and China is basically catching up. All right, ever since 2006, you'll see that the gap between the growth in China and US market is getting smaller. All right, and because China is part of Asia, right, which is nearer to Malaysia, and of course we also do a lot of trade in China and United States. Maybe not, because we are also in a lot of we'll not say crisis, but we have a lot of debate with US as well, right? With them saying the plantation companies are not using the proper labor law, and of course they say that palm oil is not good, and so on and so forth, right? And of course they have also did some embargo on our products and services. But then again, can we rely on China, right? Because China is one of the fastest growing economies in the world, and you can see that the gap has already been going down, right? So this is a quarterly annual growth rate for China, all right? The one that you see, the histogram, the blue line, that is the GDP growth on a year-to-year basis, all right? So you can see that it has been actually going down. In fact, most of the economies or the economic growth has been going down ever since 2012. But you'll see that China has always been about above 5% GDP, right, growth rate. Okay, and of course, in the first quarter, you can see that one that went negative, right? That's 2020, year 2020, and the first quarter, right? And that's when the pandemic actually started. COVID pandemic started, right? So most economies has fallen. Like China is actually gone that particular quarter down about 7%, right? And Malaysia actually went down about 17%, all right, in the first quarter of 2020, right? And if you look at today, if you look at the growth in the last quarter, which is the first quarter of this year in 2021, you see a very steep jump over there, right? Not because it has grown a lot, but because the base in the first quarter last year was very low, right? So you can see there's about, I think, nearly 18% growth in the GDP for the first quarter of this year as compared to the last quarter of last year when the pandemic started, all right? But you can see here that they've actually gone positive, whereas Malaysia, in fact, until today, since the second quarter last year, okay, the first quarter in Malaysia was still positive. We are still having a growth. Okay, but the second quarter has gone down, third quarter, fourth quarter, and fifth quarter. So we are basically actually in a recession right now, right? Technically, when we have two consecutive negative growth or no growth for GDP, we are in a recession. So we are not really out of the recession yet, all right, based on the data over here. Right, so like if you look at the right hand side, that's where the Malaysian growth rate in percentage. You can see that the line, okay, the GDP growth rate for Malaysia is that line that you see, the black line you see on your chart. So it's still below zero, right? Whereas China has already gone out, it's gone 18%. So you can see a very, very strong growth in the Chinese market, all right? So if you look at earlier this year, there were, of course, people who tried to do research and find out what would be the GDP growth for China this year. And one of the local companies here says that the GDP for this year could grow 6%. But later, even World Bank, right, forecast China's GDP growth to grow 8.5%. That's after the first quarter GDP come out, right? They are more optimistic. The previous report, 6%, was because it was the first quarter. It's still within the first quarter, and the first quarter GDP hasn't come out yet, right? So when they look at the first quarter, they say now that they're expecting 8.5% recovery, right? And here, this is published on the Star, but of course, it's not from the Star. It's again from one of research, Tsinghua University Academic Center says 8.2%, right? So World Bank says 8.5%. This research, University Research says 8.2%. So they're quite optimistic with the China market, all right? So now this is basically the China Stock Exchange Composite Index, all right? So you can see the growth here. I've actually put up to 20 years. 10 years over here, all right? Just to see basically the growth over the 10 years, all right? So you can see in 2020, during the pandemic, the market actually just pulled back a little bit, all right, in the early 2020, despite you see the economic slowdown in the first quarter of last year. But the index, right, which represents equities in Shanghai, has just pulled back a little bit. Then since the first quarter, the market started to rebound, same like Malaysia, in March onwards, you can see the index just continue to increase. All right. So if you look over the long term a little bit, right, the performance in the past 5 years for the China stock market based on the Shanghai Stock Exchange Composite Index is about 24.5%. The 10-year growth is 35.9%. All right, this is generally the general market outlook. We use this benchmark. It's the same thing like how we use our KLSE or the FTSE Bursa Malaysia KLCI index. All right, now this is another new index. This is called New China. All right, so S&P actually came up with a New China sectors XA shares index. And you can see, and this New China, I will talk about New China in a short while, right? What is New China? Okay, later we actually look at a component of the index. Then you know that these companies pretty much they are quite tech related. All right. So if you look at New China sector, you see the compare with the growth in the Shanghai Stock Exchange Composite Index. Right. So if you look at the 10-year growth for the composite index is 35.9%. But for this particular index, the 10-year growth is 167%. All right. And you look at the 5-year growth is also quite significant. It's 127.1%. Okay. So this is a very strong growing market. And you look at the trend here, it's still very much strongly bullish. All right. And of course, the most bullish market that you can see today is basically the US markets, right? And they are all going to historical highs. But now that China is actually catching up in terms of its economy and also its growth, China can possibly be a very strong growth market. All right. But of course, we also have to take a look at the risk later on. So this is China, the index, right? Remember to talk about the S&P New China Sectors XA Share Index. Okay. It has about 92 shares, 82 from China, 10% from Hong Kong. Of course, the biggest weightage are all in China. There's 86.4% of the companies on the total market cap, okay, are in China. Okay, so this is from S&P. You can get this data from S&P. Okay, so this is the sector breakdown. So you see consumer discretionary is 42.9%. That's the biggest weightage. It's basically consumer discretionary are basically companies like Alibaba, Baidu, JD.com, and so on. These are like the Lazadas and the Shopee. Where they provide e-commerce, right? And then we have communication services, okay, financials 15.9%, healthcare 10%, and the others are all basically quite small in the weightage. All right, so the biggest is basically consumer, and you add and communication is already more than 60%. All right, so what are the companies, right? So these are the top 10 constituents, top 10 shares in that index. All right. So again, this is we have companies like Tencent, the gaming company. We have Meituan. We have AIA, which is a financial, which is basically insurance, right? We have Alibaba. We have Ping An, and these are all names that you can recognize, right? These are all basically big names in China. All right. So that if you look at this 10 constituents itself, it holds quite a lot of weight on the index. So meaning that if you are comparing your performance of your market, of your portfolio with this index, you're basically comparing a performance against all these companies over here. All right. So there's continued to growth, right? These are the news that I pick up quite recently, right? Like for example, here it says European companies plan to invest more in China after the pandemic, right? Despite there are still some trade crises, right, between US and China, of course, right, and also Europe. Okay, if you go and dig further, you see there are some. I'll show you later. There's also a news about this. All right, but they do plan to invest more in China. I think they see strong potential growth in China. You look recently as well. The imports grow at the fastest pace in a decade. That means in 10 years. Okay, and trade surge continues. Basically, China is now becoming one of the most important consumer market as well, as part of other than US, right? Because US has always been the biggest consumer market, but now China is also fast growing. Okay, and you can see here this news as well. The China state, right? Chinese state is like you talk about sovereign funds like EPF and Khazanah and all that. Now they're starting to even pumping money into the private equity. All right. So you can see there's always, every day there'll be news about China, right? So the question is, do we want to actually have an exposure in China? Okay. And we do not need to buy all the companies that we mentioned here, right? Like Tencent, Meituan, and all that, because you need quite a big capital to actually own all these shares, isn't it? To start a portfolio for these shares. And that's the reason why we have Nelson, who's going to share with you how you can actually be exposed with your investment in these companies, right here in Malaysia, and you don't need a really large capital. All right. So again, I just want to share with you. So I already seen, even from the data itself, there is potential growth in the Chinese market. But like I said, you need to dig deeper. All right. Your decision is basically is yours, right? I'm just basically showing you that there is possibly a growth, potential growth, but again, you have to do your own due diligence. All right. Now, there are definitely risks. U.S. and China has always been at at daggers with one another, right? Even from during Donald Trump's time until today with Biden, they are still setting up quite a number of embargoes or strike against China. Okay, so the relationship is geopolitical between US and also Europe, because Europe also see there are some deal which has been suspended, like with China. All right, but all this is being seen as well. Okay, so again, political and geopolitical, right, across nations, there may be some problems, especially with the Western market. All right, so that's one. The other part, all right, which is not just only in China, but you also see in the rest of the world, right? Inflation is really now cropping up, all right. So and of course, during recession, the one of the symptoms of recession is basically prices of goods going up. And even Malaysia, you already see right now, right? Recently, there was this whole debacle about oil prices or cooking oil prices, which has gone up quite substantially, right? And normally you buy 5 kilo of cooking oil is like 20 over ringgit, and now it's gone above 30 ringgit. That's a 50% jump, all right? So we are seeing prices generally start to increase, and in China itself, you also see prices start to increase. Okay, but the good thing, of course, is as GDP growth in China is definitely much stronger than in Malaysia, so they should be able to take it a little bit. All right. Another possible risk in China is also their population. This is one of the things that they are now quite concerned of. It is also like in Japan, right? They also have this concern because China only have this one-child policy. All right, now they are talking about a 3-child policy for China. So there's still an ongoing problem. They have to settle this because we do not want, if you look at long term, after 30, 40 years, you don't have all old people in China only. All right. So this is one of the risks as well. And of course, there are also other risks. Again, you have to dig in and see what are the potential risks. Okay. So that's China, right? And so I'm going to leave this to Nelson later to tell you how you can actually invest, because Afin Huang Asset Management actually has a product, okay, that actually follows the new China index that I've just mentioned to you. Okay, so I'll leave that to Nelson. But this is what's happening in China at the moment. Sorry, Nelson, you say something?
Yeah, so I'll share it later. Yep.
Yep.
Continue. Yep.
Okay, so I'm going to go to the next one, right? I know last week I actually gone too long. Okay, so I'm going this. I'm just basically now sharing with you guys what should you look for, right? And again, if you really want to have exposure in China with the growth that you probably see, especially after once the economy start to grow again after the pandemic, you should see China. In my opinion, again, this is mine based on my own due diligence. I see this could be a very strong growth sector. All right. Now, let's take a look at real estate, because this is another product that you can actually trade with Trade Plus that are able to give you access to the real estate market in Asia. All right, but I know Asia is very wide, right? But let's take a look at some of the data and see which market should we focus on. Okay. Now, these are Reits performance. I'm comparing some different markets. I'm comparing US markets, Singapore, Hong Kong, and including Malaysia. All right. So if you look at the best performing index, the best performing REITs, the REIT index is basically an index, is a basket of most of the REITs in the US. Okay, if it's a US REIT, and Singapore means Singapore, Hong Kong is Hong Kong, then Malaysia represents the Malaysian REIT performances. All right. So if you look at the performance, okay, most of the REITs performance, and we all know real estate is one that has been hit hard by the COVID pandemic, and that's the reason why you see in 2020 at the peak here, most of the REITs prices has fallen down. All right, including Malaysia, including US, everywhere lah. All right. But what you can see after that, right? After March, and the dip is only temporary, right? During the first quarter of last year, and now you see that the REITs performance are starting to become better, right? And of course, the best performing REITs, okay, as a whole, as an index, US has come out. That means US has actually gone above the previous high. Okay, this is REITs performance, Okay, so REITs performance in the US has gone up above its previous high. And the second best is actually Singapore. All right, Singapore still hasn't gone above the previous high. You look at the second dotted line, that's the previous high. But it's quite close because you see the growth after the rebound in March last year. The second quarter last year, you can see Singapore is one of the better performing ones. Hong Kong and Malaysia still suffer at the bottom, but I think Malaysia one was one of the not so good ones. All right, you can see the trend is actually still going down, but Hong Kong started to rebound in October. Right, they started to rebound actually in the last quarter last year. Okay, Malaysia still ding dong is still at the bottom down here, but that could also potentially be that the market has found bottom. Right, so maybe you should also take a look at some of the Malaysian REIT, especially once the pandemic is over, when everything gets back to normal. You should see all this rebound. All right. So that being said, you can see the next best thing after the US will be the Singapore market, and Hong Kong is just starting as well. So that could also potentially be another market that we should look at. Okay. Of course, there are other REITs. I can't get REITs data for China market, because we look at, for example, even in Asia itself, Korea, Thailand and Jakarta, right? The performance are not as strong as the Singapore market. Okay, I just don't want to put here so that the chart will be too cluttered over here. Okay, so Singapore market, right? So Singapore REITs market is one of the one of the most active investment product in Singapore, and we should also basically take a look at the Singapore REITs market. All right, so we look at Singapore first, right? And you look at some of the news recently. Singapore real estate market may have brighter prospects in 2021 because we see a halt, right? A stop. Before this, the growth was very strong, but it was halted a little bit in the first quarter of last year because of the COVID-19 pandemic. All right. And you can see all these reports here, and you can always search from Google and read more reports about the Singapore property market. And most of the researchers are saying that there is, there could possibly be a strong growth in the REITs market, especially, now that most of us are going to get vaccinated, and once the economy start to open again, and especially if the borders are starting to open again, we should see more investments coming in. All right, so that's for Singapore, and you see the Singapore REIT index. Okay, this is the index represent REIT, and of course 2020 you see that sharp fall over there, right? Only for one quarter, and you can see it immediately. The second quarter it rebounded back and go back to its bullish trend again. All right, if you are able to catch it when the market is falling, then it would be fantastic, right? Okay, because the fundamentals in the Singapore REIT market, okay, is basically still quite strong. Malaysia, we do not know yet, because Malaysia did also rebound in the first quarter last year, but the rebound is not as big as the one in Singapore or even in the US. All right. Now, this will give us an exposure. So if you talk about REITs investment or real estate investment in Asia, all right. So if you look at the growth in Asia, I'm not sure about China again, because there's not much data from China. But if you look at the data that we have, the next big thing will be the best performance is actually from the Singapore market. All right. So if you look at these REITs, here is actually we have an index. This is from MSCI Morgan Stanley Index. It come up with a index, right, based on REITs in Asia, ex-Japan. And of course, they pick up REITs that are really strong in terms of performance. They have their ways to actually find what kind of stocks they actually, or what kind of REIT they actually put into their index. All right. So if you go to MSCI's website, you search for this REIT, it will show you how they actually scan this. In fact, later even maybe Nelson can also explain to you, because Trade Plus from Arvin Huang has also come out with a REIT based on this, using this as a benchmark performance. All right. So if you look at this, this particular index, right, this particular REIT index, you'll see that 63.9%, almost 64%, okay, is based on REITs in Singapore. If you look at the right-hand side of the pie chart, right, 64%, just round it up, okay, 29% is Hong Kong. The rest, we have Malaysia, which is only about 2.7%, South Korea, 2%. There's also a China REIT there, but it's only 1.6%, and others, okay, because this is Asia, right? So if you look at this, the biggest, of course, the one that moves the index is basically Singapore and Hong Kong. Okay, because if you combine just these two REITs in these two countries together, this already made up about 90%. All right, more than 90%, if I'm not mistaken. All right, 30 plus 63, about 90% now, more than 90%. All right. So the focus actually on this particular index is on the Singapore REITs and also Hong Kong REIT. All right. So now that we know that if you want to basically have an exposure in the Singapore REIT market, instead of trying to figure out which REIT to buy, okay, why not buy a REIT that covers all the REITs, all right, in Singapore, the best performing ones. Okay. So if you look at the performance, right, of this REIT index, okay, you'll see that this blue line over here, okay, so there's 331.3% from May 2027 until 2021. All right. So that's basically performance. Not 321%, but it's about 231%, because the base year is actually at 100. Okay, so 230% over the past 14 years. Okay, so if I go to, again, this is all from MSCI, right? If you look at the performance of this particular index, okay, 1 month performance, 1 month, there's not much movement. Okay, it's only 0.7.9%. This is annualized. All right. 3 months performance is 3.47%. 1 year performance 20%. So if you look at the long term, right, 5 year and 10 year is around 10% kind of performance, annualized performance. All right. So if those that kind of returns that you're looking for, okay, then this will something could be interesting for you. And of course, when we invest in REITs or even ETFs, you should think of a little bit of a longer term, all right, because you're basically investing in these kind of products, which only works in the long term. But if you want to trade, it's up to you, lah. All right. So that's why you can actually add this into your investment portfolio. So the top 10 constituents, right, you can see here in this index, and this one REIT alone, okay, called Link REIT, okay, from Hong Kong. This is one of the largest REIT in the world, one of the largest, right? Of course, in the US, they have other REITs, which is much bigger. But in Asia itself, probably this is the biggest REIT. Okay, this particular REIT itself, okay, provides a 24% weightage to this particular index. Okay, and if you notice, the rest of the other 9 REITs are all Singapore REITs. Okay, so if you combine all these 10 constituents together, right, it makes up of 68.5% of that index weightage. So these are Singapore companies. You add all them up, okay, is about 44%. All right, which is quite significant. And then 24% is from this Hong Kong REIT called the Link REIT. All right. So I've already shown you about Singapore, and of course, in Singapore, you can do more due diligence. You can actually look for Singapore, and we all know what Singapore is. I know there's a question that asked, I'm going to answer in a short while, right? Why Singapore REIT is doing well in Asia. Okay. Now, I'm going to answer that in a short while. So if you look at this, so I'm just going to cover a little bit on Link REIT in Hong Kong. So if you look at Link, all right, this company or this manager that manage this REIT real estate portfolio. Okay, right now this is on their website, or you can also get info from their website. You can see that they actually have a portfolio value 199 billion Hong Kong dollars. All right. And these are all the markets that they are investing. So you look at Hong Kong retail is the bulk of it. Car park, okay, don't play. Hong Kong car park is not cheap. All right, you want to buy a Hong Kong car park, you can actually buy even a Link house over here. Okay, it's not that cheap. Okay, Hong Kong office space, and then also China. They are also in China. They also invest in Sydney and also in UK, London. All right, so they actually have, but the bulk of it is actually from the Hong Kong real estate. All right. You look at the performance of this REIT. Okay, it also has been very, very strong. All right, so you look at the chart here, it's like just continue to go up, all right. And of course, the market or the price actually peaked on 2019, and of course, together with the pandemic that we see in 2020. But you see that the price just pull back now, starting to rebound back, and it's now starting to move upwards. Right. So if you look at most of the REIT, okay, including Malaysia one, but of course, we see a recovery in the REIT sector, right, in the REIT prices. And of course, the best performers are basically the Singapore REITs, and of course, in US and Hong Kong. Malaysia is still recovering, but it's slow. All right, so we want to go basically look for the best performing ones. Okay, so that's actually all that I have to share with you guys. Like I said, you guys actually have to go and deep dive deeper into all these, right? And the question is, now that I've already shown you this, do you actually want to have an exposure in your investment in, let's say, the new China market or the Asian REIT market? And this is where Affin Huang Asset Management through Trade Plus is able to provide you that platform. Okay, so I'm going to leave this to Nelson to explain to you how you can invest in these markets. So Nelson, now it's your turn.
Okay, thanks, Benny. I think he's really aware of, like, last week he took up almost an hour, right, of our time. But anyway, it's a very good sharing that Benny gave. Let me just share my screen. I think I do half of my job. I don't really need to sell why you need to invest into New China and REITs really right now. Okay.
Okay, Nelson, while you're putting up the chart, let me answer Wendy. Why Singapore REIT market is doing good in Asia market. Now, of course, we all know that Singapore is like the financial hub in Asia, right? At least in Southeast Asia. That's number one, right? A lot of investments go there. But if you compare the REITs in Singapore, right? And because when we're looking at the index, it includes all, right? Malaysia, we have industrial REITs, we have office REITs, we have hospital REITs and so on. Quite limited, but in Singapore, you actually have REITs for logistics, and we all know that Keppel, the shipping company, is one of the largest shipping company in the world, right? So they have REITs for it. They also have REITs for things like data center, right? Which is basically the thing that we all need right now. Okay, even right now when we are talking with each other, going through internet, you need the data, right? So we actually have the data center, and of course in REITs in Singapore, and we all know that Singapore is a very small country, right? Spaces are limited, and therefore there is scarcity, right? And that's the reason why prices of properties are very high in Singapore. And if you want to operate in Singapore, you really have to have quite a high capital, or you need a higher cost, right? If you want to operate, especially like in areas like in the central business district or CBD, right? But housing prices are still quite okay because you have that government housing, right? Like the HDB flats and all that. So they are actually still quite controlled. But if it's all private sector, I think nobody can actually afford to actually live in Singapore, right? If you look at the private condominiums, there is like 2-3 times more expensive than the HDB flats. But the HDB flats in Singapore is not like our Malaysian flat. I'm not sure whether you've been to Singapore, right? The HDB flats there are sometimes even better than all the private condominiums that we have over here, right? It's different. Okay, so Singapore is quite a unique market, right? Number one, space is scarcity, so prices of properties, assets will normally go up in the longer term. Malaysia has got a lot of space, right? And that's the reason why Hong Kong is also another market, in terms of properties, in terms of real estate, has gone up quite significantly. And that's why you have the richest man there Lee Ka-seng there in Hong Kong, right? So it's a relatively good market. And again, Singapore REIT market is also one of the best performing REITs in not just Malaysia, not just Asia, but the whole world itself. And that's the reason why it's inside that index, and you see that Singapore dominates the weightage in that particular index, right? Okay, Nelson, sorry, I can take your time again. Now it's your turn.
It's okay. It's a very good explanation. Yeah. So I think after a very good explanation that Benny just gave, right? So I think the question now is how you can have a much, I would say, cost-effective and efficient way to invest into either new China market that we shared earlier, or the REITs market, right? So I'll just share with you guys how. Okay. So of course, I always start with disclaimer. It's mainly for sharing purposes. There's no investment advice lah. Yeah. So if you're interested in the product that we're about to share, please head to our website www.tripplus.com.my. Take a look at the prospectus. Take a look at the fund information. There's tons of fund information there. And then if you have further questions, if you don't understand anything, do reach out to us. We'll be more than happy to assist you further. Okay. So first, to invest into these markets, right, in Malaysia, one of the ways that you can do sorry, can you guys see my slides? Wait, sorry, let me just share my slides again. Is my slide showing already?
Yeah, now it's showing. But I have to interrupt you for a while.
Yep, sure.
I forgot to make a very important announcement, because we actually have prize giveaways, right? So stay tuned until the end, right? Then we'll announce how you can participate and stand a chance to win 100 ringgit of a mystery voucher, right? 100 ringgit worth, and we're going to give out to 10 people, all right? So please do stay until the end. Okay, so Nelson.
I think those who have joined us for the previous few webinars, they know what is the mystery gift already. But guys, we can change the mystery gift, okay? But it's $100 worth lah. So do stay to the end. Okay, so to continue, the ways that I'm here providing is ETF. ETF also means exchange traded fund. I'm going to run through very, very quickly what is an exchange traded fund or what is an ETF. Is because some of you may heard or know already, but some of you may not. ETF is, we do have ETF in Malaysia, but some of you may not know that we actually have ETF in Malaysia. So I would always like to do a comparison between put ETF side by side with unit trust and stock, because most people in Malaysia, or those who are listening here, know that what is unit trust and what is stock, and most of you probably invested into this both investment product, right? So ETF is actually a hybrid product between unit trust fund and stocks. So it has a feature that's similar to unit trust or stock. So for an ETF is similar to unit trust. It is a diversified portfolio, but it is actually traded on the Bursa Stock Exchange. So Malaysia listed ETF will be traded through Bursa Stock Exchange, and how you're going to trade it is basically you just need a CDS account. So this is why that I told you just now, I mentioned right just now, where you can use your ringgit to invest into get exposure, diversify your portfolio into China market or REITs market, right? By not even bothering about exchange rate, right? You can just use your ringgit because it's traded, ETF is traded through Bursa Malaysia, right? So this is the feature of the what ETF is lah. And one thing about the ETF is actually index tracker. So the objective of an ETF, right, is to track the index as closely as possible. Whereas for unit trust, the objective is to outperform the index. So what a unit trust want to achieve is very actively managed. So unit trust actively managed. There's fund manager there to see which stock to buy into, which market to buy into, when and what time and why buy into this company, so that they can outperform the index. Whereas for ETF, it's passively managed because it's just track an index. Be it bull market or bear market, it will continue to track the index. If the index go up, it will continue to track the index. If the market go down, it will continue to track the index as well. Okay. So for unit trust, for ETF, the objective is to track the particular index, while for unit trust, the objective is to outperform an index. But of course, things may not always go well, right? So there are times when unit trust actually fail to to perform or fail to outperform an index. Okay, so this is just a table that I won't go through everything, but the things that I want to point out is when you trade an ETF and compare to unit trust, right? ETF is you buy through exchange, so you are throughout the day you can actually buy already, and it's like you buying a stock. Buying an ETF is like you buying a stock. You already know what price you're entering, and you can ask yourself whether you're comfortable in buying at this pricing or not. Whereas for unit trust, it's always end day pricing, so you don't know what is the price that you're buying for this particular unit trust until the end of the day. And of course, just now I did mention that ETF is passively managed and unit trust is actively managed, and both of them we do have fund manager, but the management fees for ETF is a lot lower as compared to unit trust, because one is passively managed and another one is actively managed. And ETF, since we're buying it via exchange, so through a broker, you just need a CDS account, right? So there isn't any sales charge. Of course, brokerage fees will apply, and it depends on the broker. The charges will depend on broker. Whereas unit trust, there will be a sales charge because you are buying through a sales agent, consultants, or sales rep. Okay. So right now, Benny did a very good introduction to the new China already, so I wouldn't go into like very details, but there's still some points that I want to point out. So what is an old economy and what is new economy? So it's new economy is basically means that we are transitioning from a labor intensive manufacturing industrial to a much consumer and services focused sector, or you can say that more like much like the consumer focused and tech sector, right? So this is a comparison of what is the old economy and what is the new economy. So old economy is mainly those much labor intensive, like heavy machinery, steel, chemical material, things like that was used to uh, boost the Chinese economy and help the Chinese economy back in maybe like 80s and 90s, right? But right now, when China want to continue to move forward, what they really focus in is the tech sector. And of course, another very, very important sector is their consumer sector. Why is the consumer sector so important? It's because if you can see, right, the consumer sector in China is so important because the consumer sector, the people in China, the living standard is getting higher and higher, the spending power is getting higher and higher. So it actually sustain their own economy and continue to bring the economy forward and continue to boost Chinese economy. There's a reason why Benny shows the chart just now, right? Like the GDP in China continue to grow and it rebound right after the pandemic, like in second quarter, it actually rebound as compared to other countries where we are still recovering. But China is like boosting already. China is like recovered already. Basically, this is because the spending power is really, really strong. Okay, so this is the reason why when you want to invest in China, why not look into a new China economy, a new China sector? That's because that it is something that continue to drive the Chinese economy. Okay, so how has the new China economy performed as compared to other Chinese indices, right? So from here, I get you a 10 years return. So 10 years return, right here you can see, right, the green line, which is our new China sector X A shares index. It actually gives you about 300% return as compared to other three, I would say, the normal Chinese index, which they do have old Chinese, they do have old economy. For example, like the banking, they do have the banking because the new China sector, we don't have banking anymore. So they do have banking, and then banking in this particular index is weight quite heavy lah. Okay, so that's why you see that there's an outperformance, quite a huge, large outperformance in differences between the new China economy sector, the index, as compared to rest of the indices. Okay. If you need more reason, right, to why you want to invest in the new China, right? So it's just to give you some reason. It's like the internet penetration in China is getting higher and higher, and if right now we all know that how important internet is, of the social media is to us, right? Because we are all stuck at home. We need to use things like GrabFood. We need to use things like Lazada or Shopee to do our shopping and stuff like that. We can't go out, right? So these are really, really important, and this tech is one of the heavier constituents in this new China index. And if you look into China, like what I mentioned just now, the Chinese spending power. So if like back in 2 years ago, if you can go to Paris, if you walk into any other branded shop, right, you will always see that there's one sales rep that can speak Mandarin, fluent Mandarin, or can be a mainland mainland sales rep, right? Because they are there to service the mainland consumer, the Chinese consumer, because they are the one who have the spending power and they are the one who do like maybe bulk buy in this branded shop. I think this we don't really need to explain further because we all know that, right? And then one more thing that we can point this out is how strong their consumer is, their spending power is, and also the tech sector is, right? Is look at the Double 11 sales every year. Double 11. They just don't fail to break a new high. They just don't fail to breach another new high. So this is how to say, this is how strong this new Chinese sector are. Okay. So if you're really interested in diversify a portfolio or diversify investment to China, and then you want to gain some of the Chinese China exposure, why not look into our S&P New China Tracker? If you can search the Bursa stock code, it's at 0829 EA and 0829 EB. Why there's two EA and EB? Because we listed in both currency, ringgit and USD. So those who has USD with you, you can actually, there is an option for you to use your USD to buy into this S&P New China Tracker. But if not, you can always use your ringgit to buy into this new China sector, which means you are using your ringgit to gain exposure into the China sector. So you don't even need to worry about your forex issue, right? Because this will be bulk of the issue, and you don't even need to worry that how can I invest into China market, like which are the way that I can use, right? So ETF is one of the way that you can actually look into it. I would say it's a very cost-effective and cost-efficient way. So the last close, so today I think it closed at 8.1. So the minimum, like how you buy a stock, right? Minimum is 100 units, one lot. So it's about $800. You can actually gain exposure into this new China tracker already. So how do we actually construct this particular index, right? I think this is quite important that you guys might want to know. So what we mentioned, I think I didn't mention, but the index actually say X A share. So for this particular index, there isn't any A share. It's only H shares and ADR. So I think just now Benny did mention is 92 constituents in this particular index. So after that, we will actually screen through the new China economy sector that match this criteria only will be included to this particular index. And of course, there's also the market cap that you need to meet, and of course the average daily value traded that you need to meet. Why you need to meet all this is because we need to ensure that as the ETFs go larger, because as an ETF, right, we actually buy into the particular stocks. We actually buy into we actually hold the company. Okay, we actually buy, when you invest with me, I actually go to the market and buy the particular company. So I need to make sure that when I need to buy the particular company, is liquid enough for me to buy. Okay, it's liquid enough for me to hold, and it's liquid enough for me to sell if there's a huge redemption. Okay, after that, step 3 will be it will be weighed based on the free market cap, and of course it's up to maximum 300 constituents lah. But right now we only have 92 in the particular index, and each constituent will be capped at maximum, it will cap at 10%, and this maximum cap at 10% will be happen at the rebalancing date. So after rebalancing date, right, the price of the share price will move. So this will actually move the weightage as well. Then this particular index will go through a semi-annual rebalancing. So every semi-annual, every June and December, it will go through the screening all over again, and then we'll screen out the latest new China economy sector, and then weight it according to the market cap again, and then this cycle will go through every semi-annually. Okay. So this is just a performance chart that I want to show you. I launched this particular fund at January 2019, and till today, it gives you a return of, since inception returns about 58% as compared to the benchmark is 65%. So if you were to compare, right, I'm actually tracking it quite closely. So if you can see this, the blue and the red line, you can tell that it's quite closely tracked. And we did our very first income distribution last year in November 2020. It's about Hong Kong dollar 38 cent, and it's equivalent to about 20 cent ringgit. 20 cent ringgit, and then the yield is about 2.5%. Okay, so as you can see, this particular index is doing quite well. Okay. And what is in the ETF? I think Benny did show just now earlier. We have Tencent, Meituan, AIA, Alibaba, JD, Ping An, Baidu, NetEase, NIO, and Wuxi Bio. I think these are all the new China sector. Well, considered new China sector, and you can tell that it's all mainly tech related, and it's not only tech related but also consumer related, like Meituan, JD, even Ping An, all these insurance company. They are all consumer focused sector. Okay? So after I've talked about New China, if you have any question, do please sit down. I'll answer you later. So about this New China, and if you want to have more information of this New China, and then you really want to know more, do head to our website, and there's more information that you can find from there, or our Facebook page. Okay. So the next thing that I'm sharing with you is REITs. Just now Danny already shared with you the index, right? But my index is not the one that Benny shared with you. Mine is a little bit more, I would say, new in Malaysian market. Why? Because we have this feature, which is smart beta feature, or you can actually say that is factor investing. So how is this? How does this smart beta actually works, right? So to give you a very quick guide is, I actually look for those stable and consistently high yielding REITs. I choose the REITs that pay a consistent and slightly tilted towards high yielding to include into this particular index. That's why I call myself a smart beta strategy, because like I mentioned just now, ETF is a passive strategy, right? So I put this active touch into it, which I put this factor. I only want those REITs that give you a consistent and slightly higher paying REITs counter. Only you need to fulfill this criteria, then only I will include in my index. That's why it's a smart beta strategy, and it's slightly different from what Benny shared earlier. So the index that Benny shared earlier is my mother index. Okay, it's the mother. So from the mother, I choose out who actually pay out. So the first step, I got a mother already, which is what Benny shared right earlier. Then the second step, I have this dividend sustainability and persistent screening. So from here, I choose those particular REITs counter that give you sustainable, that I keep mentioning, sustainable or persistent, like those consistent, like slightly more consistent and high tilted towards dividend. So for example, those zero or negative payout or even extremely high payout REITs counter will be excluded. Why? So for example, today I include these REITs. For example, give an example, just very rough example, link REITs. Link REITs is in my this index, yeah. So for example, link REITs, let's say link REITs give me a they always give me a 4% yield every year. So the consistent that every year they give me a 4% yield, right? Is considered as a consistent and slightly high tilted towards paying REITs counter. So I will include it in. So for example, as I got another REITs counter, they normally they pay me about 3% every year. Then out of nowhere they pay me 10% for that particular year. So this kind of REITs counter I wouldn't include into my this index, because this will actually I would say impact the my dividend income to my investor, because my this particular ETF one is to my this particular index is to make sure that I can give my client, if you can give my investor a consistent, much consistent and stable income. Okay, so I want to provide investor with income, just stable income stream. That's why my REITs counter will need to be stable as well. Okay, so after that, after I gone through this dividend sustainability and persistent screening, then my REITs will be weighed based on the market cap and dividend yield score, and each of the REITs will be capped at maximum 10% as well. Like I think Benny showed just now, link REITs was at 24%, right? So this won't happen on my index. Why? Because this is a way for us to mitigate from the concentration risk. Then this particular index will go through a semi-annual reconstitution every June and December as well. But on top of that, we'll go through a quarterly rebalancing on September and March. This is to make sure that the REIT is capped at 10%. Okay, so this REITs index is actually a diversified REITs index. So when we talk about those sustainable paying and high tilted REITs counter, right? People will always talk about retail or office REITs, right? But actually, it's actually not. So it's quite a diversified REITs portfolio where we have diversified REITs, retail, industrial, office, and also healthcare. And if in terms of country allocation, you can see that Singapore, of course, Singapore and Hong Kong will be the higher one. Why is mainly because Singapore is known as REITs hub, I think, which Benny actually explained earlier, right? So this is to give you a picture that it's quite diversified, and in the diversified REITs, we do have those data REIT center, things like what Benny mentioned just now, cable DC REITs, things like that. So I launched this particular REITs index back in last year, 15th of July 2020. It's not even 1 year yet, and on 31st March, before even the 1 year anniversary, I actually pay out 0.5% yield. So we all know that in 2020 the REITs didn't do well, and some of the REITs counter didn't even pay dividend, right? So when I managed to pay the dividend yield, although it's quite low, but it shows that the dividend counter, the REITs counter that I choose, right, actually quite stable and steady, who can still pay us dividend, so that I can get enough income and then pay out to my investor. So after the not even 1 year return, I've seen inception about 4.5%, and a year to date is 5.1% return, because this is what we see that the REITs recovering from the pandemic. Okay. So these are just holdings, the latest holding. We got 15 REITs in total after the recent Constituents. We got 15 REITs in total, as compared to, I think, the one that Benny showed earlier was a lot more, I think 40 over, if not mistaken. So this, we only got like 15 here. And if you want to know the latest holding of any of ETF, right, I just give you another hint. Just head to our website as well. For ETFs, we don't hide our holdings. We let you know what entirely, you can see what is the entire holding, entire list. Even for the new China just now, you can see the entire 92 holdings, what we actually buy into. Just head to our website, download download one of our file, then you will be able to see the entire list of holdings ready, right? So why invest into REITs? Why invest into my REITs, right? One thing is same again, you use your ringgit to invest into Asia ex-Japan REITs counter, dividend focused REITs counter, dividend focused REITs ETF, and it's a very affordable option because the last closing, I think, is just 1 ringgit and 1.04, so it's about 1 ringgit per unit, and then you only need $100 to buy into one lot, right? And then it's a very diversified REITs portfolio, which I showed you earlier, diversified across different REITs profile and also country allocation. So this is the index, just the information of my ETF, right? It's listed on Bursa 0837 EA. You can just search on your, maybe you have a KIC screener, you can just 0837 EA, and I only listed on ringgit only. There's no USD for this one, yeah, only ringgit. And do check it out if you are interested in this REITs or the new China. Okay. So if you have any more questions that you want to ask, or you want to reach out to us for more information that you don't want to ask here today, right? That there are various ways for you to reach out to us. There's Facebook, there's Instagram, Telegram. We do give out, like every day we do give out, like what is the pricing of this particular ETF today, and then that you check what is the NAV, or we give you like some timely updates, like whether what is our market maker doing, and then some extra information. Okay, and then for the WhatsApp, you can just reach out to us. There will be someone, okay, that's me, that will I would say lion you in this WhatsApp chat if you have any questions regarding ETFs. Okay, if there's any question that we can take, man.
All right, awesome, Nelson. So yeah, you have that the AXJ REIT, right? And it's only less than or just less than a year old, isn't it? July 2020 you started, right?
Less than a year old. Yeah, it's about coming to 1 year. Coming to 1 year in this July. Yeah.
Next month is your first anniversary, lah.
Yeah, next month is first anniversary. Like, maybe I can say something, okay. So most of the, let's say you are familiar with UT, right? When UT say that I'm income, I'm not talking bad about any products. Right? Any product is, if you like that product, it suits you, that product is a good product. Okay. But like what you say, you need to do your own due diligence, right? So what happened is, what I say is, so most of the fund that you see, they will say after first anniversary only I start paying you, right? So we actually managed to pay before even the first year anniversary. And in such situation where we all know that last year there's a lot of government that give exemption to all these companies, saying that you don't pay you can actually don't pay the dividend, right? So, and the fact that we still managed to pay it actually shows that the risk counter that we choose is actually quality. They have sufficient cash buffer to actually continue to pay out the dividend. Because why you invest into REITs, right? You invest in REITs mainly for that particular dividend. It's the income stream that you actually want. Yeah.
Yeah, despite the pandemic that we have last year, I mean, still they are able to pay dividends. So like you said, these are all consistent paying REITs.
Yep.
Okay, and the new China ETF tracker was how long already?
Since 2019, January 2019. So I think about 2 years.
Okay, yeah,
Since
generally it's
January.
still quite new, right? And of course, you are here to actually promote these REITs. I think a
Actually,
lot of
technically
people,
speaking, I think Trade Plus is still quite new. I think
yeah,
it's just
yeah.
4 years old.
And actually, traders have a lot of other products that are quite, quite interesting as well. Even leverage and inverse products. It's just that I think
Hey, China
that's
earlier.
the reason why you are here to actually shout out, right, and to actually let people, investors, know that you actually have an alternative, right? To not just invest in the normal stock market, because or equities in Malaysian equities, because you actually have a lot of new products that are, of course, introduced by Trade Plus or some other providers, right? But of course, you see, like like China, you want to get exposure in China, you want to get exposure in US also. They actually have a US ETF, a FANG Plus ETF, right? And
Yep.
and quite a number of. So just check Trade Plus out. And if you go to their Facebook, they also have a lot of educational videos as well, right, for people to understand more about the products that you have as well. So please do check them out. Trade Plus by Afin Huang AM on their Facebook and their social media. Okay, so let's take a look at some questions. Nelson, yeah.
Sure.
Okay. So our colleague, we will post the link here for you guys to actually answer the questions, and basically the 10 person who answer the most correct answers, all right, will basically win the prizes, and you should be notified of as being a winner only after a week later, right? So please do go and click the link, which is going to be on your screen in a short while, and then you can go and answer the questions, right? If everybody get the right answer, if the 10% also get all right answers, then we'll take a look at the one who answered first. All right. So so just look out for the link and click on the link. Now let's take a look at the question. Yeah. Okay.
I saw this Sim
Streaming,
Wing key. Yeah.
yeah,
I think both of the question can come out together, right? I'm not
about the
sure if
same
we
lah.
can do that. But
Mm.
like it or not, this is the question that we really get
Every single
every
time.
session, right, Benny? Okay. This is about liquidity issue. I think I can take. Can we just publish the second question as well? Is market maker on ETF to ensure the price track on the benchmark? Yes, actually, this is how I say it's a yes. That's why market maker is very important. Market maker is not only there to ensure liquidity, to ensure that there's a buy and sell, right? They are also there to ensure that the price actually track the benchmark. Then how you can check this, right? There's anything called IOPV. Okay, so you can check against the IOPV to ensure that market maker quote the price that quoted by market makers is within the is in between lah. Okay, so where you can check this IOPV, another layman term, we will say that is lifetime NAV, the life NAV. So as and when the constituent move, right, the share price move, right, this IOPV should move as well. So if I can just share my screen again, right, I will just share you guys where you can get. Let's see, where you can get this. Can you see my screen really?
Yep.
Where you can get this. So you can go to Bursa Marketplace. You guys can see my screen, right?
Yes, can.
Okay, so you can go to Bursa Marketplace, right? Just go back to the home page. Then you just go to the. Oh shit! What's this? Sorry guys. You can just go to. Wait, what is this? So basically, you just go to Bursa Marketplace, right? there's this share market, okay, share market, then you just click on ETFs, right? So then you will land at this page. So this page, right, okay, I'll just search here, right? So this page will actually give you this IOPV. You see, this IOPV price. Can you see here? This IOPV price. So, and then the market maker bid and ask price, you can actually compare it here as well. So you can see this Trade Plus Share Go tracker, right? Give an example of this share. So you see the bid and ask price 2.49 and ask price 2.51, where the IOPV is 2.49. So which means in this case, right, you can actually quite sure that the market makers is quoting based on the index pricing. So it's a lifetime pricing, and the market maker is quoting the right pricing. So you can actually buy into this particular ETF already. Okay, so to answer your questions, I think I hope I answered your question really. Is that yes, market maker is always there to ensure liquidity, and market makers is also always there to ensure that the price track the benchmark. Okay, and the trading volume wouldn't impact. So let's say there's a large, for example, maybe you can, if you want to know more information, right, there's some videos on our Facebook page, right, that you can see how the market makers actually works. It's a very detailed webinar that conducted by us. So how the market maker ensure that, let's say there's a large volume, suddenly just jump in and buy this new China tractor, for example, right? It doesn't work like how shares price work, where it will just push the share up. But let's say the market maker don't have sufficient units to sell to you at that price really, right? Then they'll come to us. They'll tell us, hey, look, I need more units. So we will actually need to create more units. They pay us the money. We need to create more units, and we give him that unit so he can sell the unit back to you. So this is to ensure that, because I think I mentioned earlier where ETF works like unit trust. Okay, so we can create more unit. So by creating this more unit, by facilitating this particular, I would say, function, right, it will ensure that the ETF price will always track the benchmark pricing. Okay, so to answer you in short, the trading volume will not impact the ETF pricing. Yep, because there's a market maker there, and the nature of ETF where we can actually create more units. Okay.
Yeah. So be sure that because they have to track the index, right? They can't simply buy and sell at any price. Then in their fund will perform differently, right?
Correct.
So that's why it always tracks that price. So it's the market maker's job to make sure that the prices being traded, is actually on their, at least not far from the IOPV, right, or from the value of that the portfolio. So I think people always got a problem because when you see when you look at the screen, right, your bid and ask price, and then you see, your volume so little, so little people buy only, and so people sell.
As long as you see, as long as you can see the bid and ask price, then you always see that. So okay, there always one queue, one person there with I think 100,000 or 70,000 units, right? Buy and ask one. The guy will always be there one. That is my market maker. You just trade with them, you just key in the price, right? Let's say you want to buy, you just queue at the sell price that, let's say they are selling at, for example, the new China, 8 ringgit and 10 cents. Give an example, right? Just key in 8 ringgit and 10 cents. Then you will get a share you want. Let's say you want to sell. Let's say they are buying back at 8 ringgit and 0.5 maybe. Then you just sell it. You just key in that price. Then you're able to let go your units lah.
Yeah. So like you mentioned earlier, right? I mean, buying ETFs is basically it's almost like a unit trust. But of course, you want to buy unit trust, you can't go to the exchange and buy and sell, right? You have to go to the provider.
And you don't even know what price you're buying it.
Yeah, and then they'll quote you like maybe the bid and ask price 5%, 6% kind of difference.
No, there isn't any bid. No, for unit trust, there isn't any bid and ask price. You just buy direct.
They just quote you, right?
No, you just buy. You just buy the price, end price. Yeah, there's no spread for unit trust. Don't worry about that.
Of course, there's a sales charge, hidden charges.
I don't want to comment so much.
Okay, next one. How Chinese government crackdown on tech companies like Alibaba and Tencent impact the performance of the counter. Now, definitely, I mean, on the short term, there will be short-term shocks or impacts like this, right? Now, that's the beauty about buying ETFs, right? Because you're not buying one counter, you're not buying two counter, right? And the exposure, like Nelson mentioned earlier, maximum exposure in the weightage is 10%, even for the ETF, right? Okay.
Yep.
So if it's 10%, it's like 10 times, right? So if the price, let's say, even come down 30%, right, the performance of the index based on the 10% weightage is only 3%, right? So if other counters are still doing well, the ETF can still even go higher. right? So that's the beauty about having a portfolio
Because it's
instead of
already a
just
diversified portfolio
yeah.
already to
Yeah,
begin
so
with.
it's like basically when you buy one, it's like buying a basket, right? We always say about
Yeah,
don't put all
buying
your
basket.
eggs in one basket, right? Okay, so this is the example, but the good thing is you only need to hold one ETF and you actually hold all the counters there. Okay, so definitely there'll be risk, but again, the ETFs is there to actually, uh, talking about diversification is all about trying to minimize your risk, right? So it's already there. And of course, you have to keep on looking at this. Like I say, you have to dig on the risk as well, right? Like say, even government, because again, China, although they are now opening up, it looks like a capitalism country, but it is still a communist country, right? So that's one of the ways that we actually have to look at as well. Okay, Xiong Kong is asking again, Geely, Xiaomi part of S&P New China Tracker?
Xiaomi is not. Geely, yes. Yep.
Xiaomi is not, huh?
Yep.
Okay, we're going to go through all the some questions here. So Winky is asking, how would Forex affects AXJ REIT?
Okay, definitely Forex will impact the performance, right? Because like or not, I quote you at ringgit, but when I need to buy the particular risk counter, let's say it's listed on Singapore, I'll need to use Singapore dollar to buy. So definitely there will be impact on the performance as well. That's why all these things will translate into what we call the tracking error. So you can always check this at our annual reports and stuff like that.
Okay. Okay, next one. Yat Lau is asking, do ETF
But
pay
maybe
dividend?
one thing I can explain is, but because it's ETF, right, I don't actively buy and sell. So the impact may not be there because I don't actively keep buying and selling, You see, yeah.
Yeah. The review of portfolio is only done like twice a year, isn't it?
I think it's like four times a year. Yeah, 4 times a year.
4 times a year.
Yeah.
Okay, do ETFs pay dividend?
Yeah, of course. Like I mentioned just now, both for my ETF that I shared, we actually pay dividend. So ETF do pay dividend, but not all ETF pay dividend. So that's why you need to understand what you're buying into, the instrument, whether, for example, give you an example. Let's say I'm buying into last week what we share, gold, Sharia Gold ETF. I can't pay dividend. Why? Because I'm buying into physical gold, and physical gold don't give me dividend. So I can't pay you dividend. Right? Why this REITs and New China, I can pay you dividends because I buy into physical like company and REITs counter, right? And they pay me dividend. So if I collect enough dividend, then I'll pay out to the investor. Yeah.
Yeah. It is the mandate of fund managers of ETFs to actually give back the profits back to the investors or unit holders, right? They can't just keep. So dividends is also part of the income that actually the fund managers are having. So this is very simple. Yat Lau is asking, how do I buy the two ETFs? Just for me, it's just like buying a stock in your trading account, right? You just need to search for it. Okay.
Yeah.
Any
Account,
ETF you can do.
as long as you got CDS account, it's like how you buy a stock. You can just buy. So 0837 EA is my REITs, 0829 EA is my New China.
All right. Yeah, so that's why it's called an exchange traded fund, right? Because it's traded on the exchange.
Traded on the exchange, yep.
Yeah. Now, okay, this time you mentioned, the ETFs are managed passively. So what do you actually mean by that?
I think she joined us quite late, right? So okay,
I think so, yeah.
Why ETF are passive? Because ETF track the index. So for example, like example like KLCI, okay, it's not KLCI. So KLCI buy into, let's say, top 5 like public bank, all the banks like Maybank, all these things, and each is 5% weighted. Just an example, okay. So if this ETF were to track this particular KLCI, then my ETF will buy into Maybank, public bank, RHB, and all these 5 banks, and need to make sure that it's only 5% weighted. So whatever happened to this particular index, my ETF will need to follow suit. Let's say one got kicked out, my ETF will need to sell one. So that's why it's passive. I don't do any active call. I'll just follow the benchmark. Yeah, that's why we call it passively managed.
Okay, let's go on. I think we have 2 more questions here. What is the NAV for the China tracker?
I
think you
have, but this
colleague
morning it's,
Can you get it from Bursa Marketplace, or do you have to go to your
yes,
Tripla's
you can
website?
get it though. You can't get it from. Wait, let me just. We get you can get IOPV from the Bursa marketplace, but for this NAV, you actually need to follow our Telegram. Every morning we will publish our NAV. Okay.
So you actually have a Telegram group that they can actually join now.
Yep.
And you publish.
Yep. Telegram
Alright.
group Quick Plus ETF. Yeah, do join us, Eddie.
Okay. Maybe your colleague can put the Telegram link there if you want, so that they can actually join.
Yeah, maybe more of them can put the Telegram link there. Yep. I think it's up there.
Okay. Okay, Wenki is asking S&P New China Tracker, is it similar to the HS Hang Seng China Tech ETF?
Okay, one S&P New China Tracker is not mainly on tech. Okay, it's consumer focused. We do have things like just I mentioned, like Geely, and then I do have like consumer behavior more like what is that called, Hai Di Lao, things like that. It's 92 stocks there. I do have like AIA insurance, things like that, right? However, this HS China Tech is mainly on tech only. You need to be like tech only, you can be included into the particular ETF. So it really depends on you as an investor, right? Do you want to invest into such a thematic and such a focused strategy, or you want it to be slightly more diversified? So it's like mine, I give you a slightly more diversified because it's a new China economy, right? So we do have a consumer focus. I do have tech, I do have healthcare, I do have travel, I do have education, I do have like green energy, things like that. But HS China Tech, it's only tech. That's what I can say. Then it really depends on what you really want. Yeah, or maybe you want both. Yeah.
Yeah.
Yep.
So maybe next time Trade Plus can also come out with the tech sector. But I think like what Nelson says, the new China Tracker is more consumer focused, right? Because tech can be a lot. Tech can be a B2B, business to business. It can be, it can be semicon. It can be a lot of other things, right? But the new China Tracker is very much for it's consumer centric, Okay. This one is a little bit difficult. Is dividend yield better than unit trust return for S&P New China Tracker?
Is dividend yield better than unit trust return for S&P?
Depending on what unit trust.
I'm not sure if I get you correctly, but I think he is referring to, because I think we also launched another unit trust on top of these ETFs. Okay, so I wouldn't, because the particular unit trust will buy into this ETF. So whatever this ETF gives, it should reflect quite similarly to the particular unit trust. Yeah. So it should be, because the unit trust will only hold these ETFs, and then they won't do any active call. They will just hold my ETF. Of course, there might be fees there, so it might be slightly lesser, but it should reflect the same. Yeah. If you are talking about the same feeder fund that I'm talking, if you are talking about the feeder fund, yeah.
All right. Okay, thank you, Li Chu. Li Chu just put the NAV for China ETF as of 8th of June over there. Okay, guys. So if you have any more questions, you can type it right now because we're gonna end this session. Right?
Li Chu is here.
No more. Yeah, thank you so much for joining us tonight. I hope that this session will be beneficial for you guys. And again, if you want to expose or get exposure in your investment in the China markets and also the Asian REIT market, please do look at products that Trade Plus has, and you can trade it like any other stocks in Bursa Malaysia, as long as you have a CDS account. All right, you don't need to have any special requirement. Okay, any investor who has a CDS account is able to buy and sell REITs.
I think sorry. Just let me correct a bit. I think for these two ETF, I don't think you need any special requirement. If when you want to buy and then it blocks, right? Because it's ETF, it's quite new in this market. It blocks. Just give a call to Remisier. They will be able to guide you. Because, like for example, the leverage inverse, I think Manny mentioned earlier, you need additional declaration. Then for the the Sharia Gold, you might need some cash upfront, things like that, right? But for these two, you shouldn't be seeing any problem. But if you do see any block or anything, right, it's not because anything. You just give a call to your Remisier or the customer service. They'll be able to guide you and then uplift that thing, okay? And then there are a lot of broker out there for you to use. And then I think I think right now Bursa has some campaign. I think, and it will be I think it's like I think $100, $50 or $100 if you invest like 2,000 in ETF. Like the campaign period is until 31st of July.
July.
Okay, and then what else? Then we do have more webinar coming up for Trade Plus, right? Next week we do have more webinar. If you are interested, please head to our Facebook. There are tons of information that you can get. Okay. Yep.
All right, awesome. So thank you very much, Nelson, for joining us tonight and also share with
Thank
us
you,
the
Benny.
two
Thank you,
products.
Benny.
Right. So
Thanks
and
to
also
join us.
for those who join us, thank you so much for joining and have a good evening. We'll see you
Stay
again.
safe.
Stay
Stay
safe
guys.
and good night.
Good night. Bye.